Welcome back to the Digital Asset Report. Today, we're going to talk about something new. That is the big shift that's taking place with the way that people think about money, investing, and legacy. Not long ago, digital assets like Bitcoin were seen as risky or experimental. But now they're part of more serious conversations, especially among older investors who are focused on preserving wealth, planning for the future, and passing it on to the next generation. Digital assets offer something that traditional investments often don't. They're accessible from anywhere, they trade 24/7, and they're built on transparent systems. That kind of flexibility and control is appealing, especially to people who want their portfolios to match the pace of the modern world. And with the right guidance, crypto doesn't have to feel risky or confusing. Today, it's not just about speculation, it's about strategy. A growing number of people over 50 are adding Bitcoin and other digital assets to their long-term plan. They're not doing it for the hype, they're doing it because it makes sense. Gen X, for example, is currently spending more on crypto than any other generation. And while younger generations are more likely to own crypto, older generations often have more money to invest, and they're being thoughtful about how and when they do it. Another clear sign of this shift is in estate planning. Professionals now regularly talk to their clients about how to securely pass on digital assets, making sure their heirs can access wallets and private keys. That's a major step towards crypto becoming a mainstream part of family wealth. Even elite networks of ultra-wealthy individuals are embracing it. Groups like R360, which is made up of centimillionaires, have publicly backed Bitcoin both as a store of value and as a tool for collateralized lending. This kind of endorsement shows that crypto has crossed a new threshold. It's no longer something that the ultra-wealthy avoid, it's something that they're actively using. And we're seeing more confidence from investors overall, especially after the approval of Bitcoin ETFs. Around 1/3 of high net worth individuals say they're more interested in crypto now than they were before. And that's leading many to explore where digital assets fit in their broader strategy. For older investors, it's about future-proofing their wealth. Many are looking to protect their purchasing power, especially in a world where inflation, currency debasement, and political instability feel like real risks. Bitcoin's fixed supply and decentralized nature make it a compelling hedge to protect against those pressures. And stablecoins, cryptocurrencies designed to hold a steady value, offer a practical way to move money globally or diversify without added volatility. Digital assets are also becoming a key part of legacy planning. Families are starting conversations earlier and involving younger generations in decisions and financial planning. And because younger heirs are often more familiar with crypto, these conversations are building a bridge between generations. More and more, it's clear that digital assets will play a role in long-term wealth management. Technology is already part of everyday life for this group. Many older investors already manage their finances online, use mobile banking, and follow financial advice on social media. Adding digital assets to their strategy isn't a big leap, it's the logical next step. And the barriers that make crypto hard to access have mostly come down. Regulated platforms and insured custodians now offer professional-grade services that make investing in crypto secure and manageable. There are also new ways to earn from digital assets. For those exploring beyond Bitcoin, staking offers a way to earn passive rewards by supporting blockchain networks. And in some cases, those returns are significantly higher than traditional products like CDs or bonds. Depending on the platform and asset, staking rewards can range from 5% to even 20%, making it an attractive option for long-term holders who are willing to be patient. More financial institutions are taking notice and moving fast. Recent regulatory changes have made it easier for US banks to offer crypto services, clearing the way for broader participation. BlackRock, for example, launched the iShares Bitcoin Trust in 2024, and it already manages more than $58 billion. They see digital assets in 3 buckets: crypto like Bitcoin, stablecoins, and tokenized assets like their on-chain fund called Build. Even BlackRock CEO Larry Fink has called Bitcoin a hedge against currency risk and global instability. Their Fidelity digital assets platform lets clients invest in crypto directly, invest through ETFs like the Wise Origin Bitcoin Fund, and soon they'll launch their own stablecoin. They've been building in this space for over a decade and will continue to lead and innovate. Franklin Templeton, which manages over $1.5 trillion in assets, has embraced digital assets as a fundamental part of global finance. They offer a wide range of crypto products, helping clients diversify their portfolios with modern tools. BNY Mellon, which is one of the oldest banks in the US, launched its digital asset custody services in 2022 and recently added powerful data tools to help clients monitor activity across blockchain networks. Their CEO calls crypto their longest-term play, a clear sign of long-term commitment. For private banks and wealth managers, this presents both a challenge and an opportunity. Those who move early and invest in digital asset capabilities will be better positioned to retain clients, support generational wealth transfers, and stand out in a crowded market. This isn't just about keeping up, it's about gaining a new edge. Digital assets also represent a powerful new revenue stream. Just like firms had to evolve during the tech boom, we're now seeing a new wave of wealth driven by crypto. Advisors who understand this shift and invest in the right tools and education will be better prepared to grow with their clients. On the flip side, firms without a crypto strategy risk losing relevance. As client expectations change, money will naturally flow to platforms that can meet those needs. Advisors who don't adapt could lose wallet share and credibility. To deliver digital asset services effectively, firms need modern infrastructure. That means secure custody, updated compliance systems, clear reporting tools, and ongoing education. Without those, it's hard to deliver at scale and even harder to earn clients' trust. That's where trusted partners come in. More institutions are turning to crypto-native infrastructure providers to help deliver secure, reliable services. Biko is one of the most established names in this space with over a decade of experience supporting some of the world's biggest financial institutions. From regulated custody and staking to trading and treasury services, Biko provides the backbone for thousands of organizations integrating digital assets into their offerings. Digital assets aren't just a trend, they are now becoming a cornerstone of how wealth is built, managed, and passed on. And the people in firms who recognize that early are the ones that will lead the way forward. That's it for today. Thanks for watching. If you enjoyed this video, be sure to give us a like and a follow and head over to bitgo.com to learn more.